Global stocks slide on fears the US could be headed for recession. Welcome to Market Insight. I'm Elena Casas. Global markets are tumbling this Friday in a sell-off that started on Wall Street on Thursday afternoon after weak US factory data ignited fears the Federal Reserve may have left rates too high for too long. That was exacerbated by today's crucial US jobs number just out. The US economy added 114,000 jobs in July. That's well below estimates of 175,000. Well, for more, I'm joined now by Nick Shenton of Artemis Fund Managers. Nick, hi, thanks for joining us. We've seen a fairly dramatic reaction to US economic data today. Why?
Well, markets are discounting mechanisms, as we all know, and one might hypothesize that markets had been pricing a scenario more akin to a soft landing or a Goldilocks scenario, some call it. And this recent data has maybe called that into question. So it looks like markets are selling off from discounting a more optimistic outlook for the economy to something that's perhaps a bit more realistic.
Is this then the market giving the Federal Reserve a fairly bleak review? Has it concluded the Fed has left it too long to cut and should in fact have moved this week perhaps?
Quite possibly, but I think we're all experts with the benefit of hindsight, and who'd be a central banker at this time trying to call things almost down to the minute of when rates should be reduced. Nonetheless, it does seem reasonable from the market's perspective to say the Fed, as the leading monetary policy setters globally, were behind the curve, looking at inflation coming through the pipe, and so had to hike hard to follow inflationary pressures, and some suspicions that they perhaps held on too long. And the US is showing signs of being an economy that is in something of a slowdown.
Chip makers have been particularly hard hit after Intel's results. Are we going to see that weakness feed through across the AI-focused sector, do you think, including chip makers here in Europe?
To put it as simply as we can, every company we speak to is excited about the prospects for AI, but is also struggling to find a tangible use case here and now to generate further revenue from it. And we're talking about these as users of AI rather than purveyors of AI services. And so in summary, it does look as though the market has been perhaps a bit ahead of itself on the hype cycle, as they say in AI. It's hugely capital intensive on the behalf of the hyperscalers, and it's very, very hard for them to time the supply increase they're putting down with demand. But as I say, here and now, it looks as though hope and expectations are ahead of reality for companies that can find clear and tangible products and revenue models.
To go back to the dilemmas of central bankers, Nick, here in the UK, of course, the Bank of England did finally cut yesterday. Could that potentially be a tailwind for UK stocks?
Potentially, yes. We start from the position that you'll never meet a fund manager who's bearish on their sector and their strategy. We at Artemis have been resolutely optimistic about UK equities for a long time, primarily because of valuations. And this is a further signal to international investors to look at the UK, because actually we were to consider savings ratios in the UK, that they're demonstrably different to the US, where savings ratios are very, very low. And unfortunately, many people have to live paycheck to paycheck. The UK is in a much healthier balance sheet position. So that could be a signal to international investors.
Nick Shenton of Artemis Fund Managers, many thanks for your thoughts. And that's Market Insight. Don't forget, you can watch more videos on Reuters.com.